Well, we've seen the numbers come in. Full year profit, as I was saying, up 17%, turnover up 16%, a grinding capacity more than doubling to 1 million tons per year last year. Just run us through the year that was for the company, because compared to your peers, it seems to have been a more positive one.
Yes, you're correct. We have had a fairly decent 2010. In which the company saw growth not only in its cement turnover, but it also saw growth in all its non-cement businesses. Our fertilizer division grew by about 44%. Our minerals grew by double digits. It was more than 10%. The silicate and the lime business was steady. So overall growth for the company, 16%. Growth driven by all the divisions in the company. Cement in particular did well. We had added up capacity towards the end of last year, and that increased capacity led to the growth which we have seen in the cement division last year.
Increased capacity has come to be synonymous with Athi River Mining. Run us through to what kind of demand scenario you're catering right now.
Well, in Kenya, the total demand in the year 2010 was close to 3.7 million tons. Now, in terms of the grinding capacity, our market has got enough capacity to service the market of 3.7 million tons. But in terms of clinker capacity, we are short. Our clinker capacity today is close to about 2.6, 2.7 million tons. To service the demand for 3.7 million tons, all the cement companies last year resorted to import of clinker. Athi River Mining last year added capacity in its clinker division. We doubled our clinker capacity from 300,000 to 650,000 tons. We also increased our grinding capacity to about 1 million tons. So overall, our capacity in clinker has doubled. We want to service the clinker market locally. Cement, we have the capacity to import clinker and service the market should the demand be there.
Of course, you know, that kind of capacity ramp up not only happening in Kenya, we've made mention of the kind of expansion we're seeing in Tanzania as well. In terms of funding this capacity expansion, though, Surendra, what are we looking at?
Well, in terms of the Kenyan capacity, the funding for the Kenyan capacity was raised a couple of years ago. We had term loans to fund the expansion of the clinker plant in Keloleni, as well as to fund the new grinding plant in Athi River. We have secured the funding many years ago, and so there was no new funds which were raised during the last year to complete this capacity. In Tanzania, we are looking at an overall investment of about $100 million. We have already raised the funding. Last year, if you remember, we went through an ELN, which was the first on the Nairobi Stock Exchange. We have raised and completed the funding for the Tanzanian expansion, and over the next 12 months, we'll be using this funding to complete the project.
Of course, this in a highly competitive arena, and competition has been one of the biggest challenges plaguing cement producers, whether it be by new entrants or players like yourselves ramping up capacity. And it's certainly filtered through to pricing structures as well. We've seen reports out that the price of cement may decline by as much as 10% this year. How is this impacting your pricing structure, the competitive landscape that you find yourself within?
Well, we had always expected that the competition would grow. And as a strategy, whether we are operating in Kenya or in Tanzania or any other part of the world, we always prepare our plans on the most competitive scenario which is going to be present. Now, for example, a couple of months ago, the cement was being sold at around 10% higher than it is today. But we had always expected that once the capacity ramps up, the prices will go down. So our entire feasibility studies, all our budgets, as well as all our plans were made on the most realistic pricing in the market, given that the competition was increasing. Now, in terms of our deliverables to the market, I don't think that's going to change because of this pricing. We are at a pricing which we have already assumed in our projections, and we are confident of delivering what we have promised to the market.
What's your view on the currency levels that we're seeing right now? Because that weaker shilling plays for you on two fronts. On the more positive front, it could well bring some relief where we had cheaper imports out of China proving to be quite a challenge. On the other hand, it raises the prospect of higher input costs for the company moving forward. And so that a possible added burden that we need to be factoring in as well.
I agree with you completely that the depreciation of the shilling has two sides of it. It makes the imports more costly, and therefore to a certain extent it justifies our strategy of putting up clinker capacity rather than putting up grinding capacity as the other manufacturers in the market have done. By importing clinker, you are importing 80% of the finished product, which essentially means you are paying additional cost for 80% of the raw materials. Whereas we have put up clinker capacity and we would be manufacturing clinker locally, it doesn't impact us. It in fact gives us a competitive edge over the other manufacturers. Now, on the side of the imports which we do, Athi River Mining exports approximately 30% of its products. There would be an increase in our cost of imports, which would be compensated. It's a natural hedge. It would be compensated by the exports we do. So the net impact on us would be marginal.
So that on that front, of course, you've highlighted earlier on that we've seen volumes and sales increase when it comes to the fertilizer side of the business. Profits up 44% on that front. Yet we've also heard mention of Athi River Mining splitting or spinning off that fertilizer component of the business. What kind of progress are you making on that front, where we know that you were in talks with private equity players at some stage last year?
Well, you're absolutely correct. As a strategy, we are trying to have business-focused divisions, business-focused companies, so that each of the division, the cement would have its own team, the non-cement would have its own team, and the fertilizer would have its own teams. Now, we have been speaking. There are several options which are on the table. Going public with the non-cement division and with the fertilizer division, bringing in private equity players, bringing in strategic investors. At the present moment, the company is evaluating all the options. We have not reached to a decision, but we hope to have a firm way forward on our non-cement businesses and on our fertilizer business in the next 6 months.
Spelling what for your position within the consolidation debate? Is Athi River Mining at this stage open for M&A activity?
At the present moment, we are looking at growing businesses. We are planning to consolidate our businesses. We are planning to grow regionally. We want to have a pan-African reach. Now, there are several options by which we could achieve that. We are considering all the options. As I said earlier, a little while earlier, we have several options on the table. We are considering each one of them very carefully. We are understanding the implications of that for the company as well as for the shareholders and for the value creation which we are going to do. I think in the next 6 months, we would have a clear direction forward on our consolidation and on our strategy forward for all the divisions.
Bottom line, Surendra, are you open as a takeover target?
Well, Athi River Mining has been a family company. It's been run as a family. It was started 40 years ago, and over the 40 years, the majority or the founder shareholders have always found ways of creating value for the company, creating value for the shareholders, but not diluting themselves or giving up the control of the company. Now, the history of the company says that we have never sold off our businesses. We have always added value to the divisions which we have done. So the question which you're asking is a slightly hypothetical question. The history says we have always worked towards increasing the value of the company rather than having a trade-off sale.